with saying first, I understand that a lot of people are in a difficult position right now. And, and if you take anything away from this, I want it to be that the hardest part of saving money and trying to achieve financial freedom is our spending, is cutting the expenses. And so right now, this is a good opportunity to use this to where we're being forced to cut our spending. It's not as convenient to go out to eat or to go shopping. And so we're already going through the hard part of being forced to save our money. So if you take anything away from this, I just want it to be that we can use this as an opportunity that once things return to normal and we're able to go shopping and get out to the malls and to restaurants, and if life returns to normal, which will be a new normal, right? That don't let it all go to waste, right? So if you've already done the work of saving money, which you are, I hope that you're able to look at your budget and see how much money you're saving right now. But when things return to normal, don't forget that, or don't let it go to waste. Try to keep those spending habits in place and intact. So that's kind of where I'm coming from with this. But I just wanted to talk about how, as a business owner, but then also personally within our family, a family of 3, soon to be 4, how we've been able to save money, pay off our debt, and live fairly comfortably on meager income. So it is doable to do all 3 and to try to make small steps to financial freedom. So I'm going to try to make this very succinct and work through the various tips that I have. But if you have questions, feel free to comment, and then I'll try to get back to those. Okay, so another disclosure, we come from a place of privilege. So we're a dual income family. We both have income. We come from good families. We both have college educations. So we don't take any of that for granted, and that has had a huge part in setting us up for success. So I just wanted to say that. Secondly, this is not coming from a place of, ooh, look at us, we're bragging, but I really want it to be, I want to empower you that we are just middle class, average people who have bills to pay. I'm running a business. I don't have stable income. We have daycare, we have expenses just like you do. And so if it's feasible for us to save and to pay off our debt and try to get to a place of financial freedom, then it's possible for you too. And then just selfishly as a woman, I'm really frustrated by the lack of, women are very cautious about talking about their money. A lot of people are afraid of money. They're afraid to talk about it. They don't know how much debt they're in. And if somebody is successful, if they're a woman, they shy away from that, from talking about it. And I just want to show other women who are in business or just in general that it's okay to talk about money. At some point in your life, if you are married, you're probably going to be in charge of the finances at some point. So I want to empower you to understand your financials, know where you're at, and have some financial goals. So I hope that with these 5 steps, you're able to do that. Okay, so I'm going to share my screen here so that you're not staring at me the whole time. Okay, so let's see. Okay, number 1. Like I said, the hardest thing to do is control your spending. You cannot necessarily control your income. Whether you're a business owner, you cannot necessarily control or dictate when clients come to you or how many customers you have. If you're working for somebody else, you can't just say, oh, it's time for me to get a promotion. I highly, encourage you have to be your biggest advocate, and you have to talk to your boss and know your worth and get paid for what you're worth. But it's harder to control your income. What we can control is our expenses and our spending. Okay, so in general, the very first step to financial freedom is your income has to exceed your expenses. And I know this sounds super basic, but time and time again, I see it where people will say that they're paying off their debt, but they're still maxing out their credit card. they're still spending more than what they earn. So find out how much debt do you have total, credit card debt, student loans, your mortgage, everything that you have. Find out what the total amount is. Go through monthly, either your bank account, a lot of bank accounts will have this budgeting tool where it'll categorize your expenses for you and you can just export it that way. But if your bank doesn't provide that, you can use Wave. It's like literally like spelled like you would Wave. Wave accounting, it's free. And you do have to go through and categorize your transactions, your expenses. But once you've done it once, like once you've said this is Walmart, it'll do it automatically for you. So I recommend trying to get to a place where you are looking at that monthly. So every month I will go through, categorize all our transactions, export it into Excel so that I can get a spreadsheet like this to see how much are we spending. This is our actual spending here. So you can see mortgage, your loan, car loans, student loans, that's kind of what takes up the majority of our spending. In general, your goal should have, you should be spending 50% of your money on needs. So that's gonna be all of your loans, your utilities, daycare, insurance, things like that. 30% should go to wants. So that's gonna be eating out. Embarrassingly, this is embarrassing for me to see that dining out, snacks, it adds up to a lot. So I would say that is a want. Travel, entertainment is a want. I would even say we've never had cable, but we do have Netflix. And so I would say that is a want. Clothing, even cell phones, right? Like, do you really need to have the latest, greatest phone? We always try to keep our phones for as long as we can until they completely break. So I want to say that we try to take one vacation each year. Kind of depends on whether I'm pregnant or not. But I don't want to say that we don't, yeah, we still spend money on things that we don't necessarily need. But the goal is that you need to look at what's important to you. Is it important to you to travel? Okay, great. Then set aside a budget, a certain percentage that you're going to spend on that. But then once you're able to look at this every month, you can kind of see like, okay, this is how much we usually spend on eating out. Let's set a dollar amount or a percentage for our goal. And then each month compare to see how we did and try to reduce that. If travel is not important to you, but you'd rather have your kids be involved in a lot of activities and they want to do all the traveling teams and sports and things, fine, like that's fine too. So just figure out what's important to you, but make sure that you're reviewing it and that you try to set some goals and you're at least you're trying to get to a place where your income is exceeding your expenses. So that's step number one. Step number two is you need to pay off your debt and you need to build your credit score. Okay, so for those of you who are younger, like college age or in your 20s, the best way I think that you need to build your credit score. I know Dave Ramsey tries to say that you should get to a point where you don't have any debt. It's unreasonable where people can just pay cash for a home. So for most of us, we're gonna need a car loan or a mortgage at some point. You are not gonna get approved for that, or you're gonna have a super high interest rate if you have a poor credit score. So I got a credit card right when I was 18, and I would only charge my textbooks to it for college, and I would pay it off every single month. So again, people will tell me all the time, our goal is to pay off our credit cards, but then they're maxing out their credit cards every month. So you have to be very careful with your credit card. I think that, a lot of people don't necessarily understand the value of a dollar. Like you have to earn that money to be able to spend it first. So you want to get to a place where your credit score is over $700. So getting a credit card at a younger age and you only charge a small amount that you can afford to pay off right away. That's the key. That way you can start to build your credit score. I think I had a credit score over 700 by the time I was like 25 then. So that's a good way to do it. With car loans and things like that, that will also help you build your credit. But the idea here is that if you don't have a credit card, if you never have any loans or anything, you have no way of building that credit score. And so, like I said, it's going to be very difficult to get approved for a mortgage once you need that. Okay. Simultaneously, you should also be paying off your debt. So I like to say that it's very easy to get to a point where your income exceeds your expenses, but I also think that you should be paying off your debt ASAP, as soon as possible. So we had probably total between the two of us, my husband and I, probably around $40,000 in student loan debt. So we both put ourselves through school and had to take out student loans. I stupidly, again, if you're younger and you can manage to not take out student loans, don't do it. It's not worth it. You'll be paying it off for what feels like your lifetime. So I wish I wouldn't have taken out student loans. I probably could have made do. I was already working. And so I wish I wouldn't have taken that out, but it's over and done with now. So try to pay off, start with the loans that have the highest interest rate. So for us, this is our student loans. Our cars have a lower interest rate. If you have credit cards, that's probably your highest interest rate. So start with credit cards, then your student loans, then maybe your car loan or mortgage, depending on what that interest rate is. Okay. Step 3, contribute to your retirement. So there is a concept called the time value of money, meaning if you start contributing just $100 a month towards your retirement as soon as you graduate, so say at age 22, you're going to have more money saved than if you start at 35, but you're contributing more. So the earlier you invest or contribute to your retirement, so this is going to be, if you work for somebody else, this is going to be your 401k. Otherwise, if you're self-employed, or you can even have a separate IRA separate from your 401k, that's what I'm talking about with your retirement. The goal is to, now they say that you need to contribute 15% of your paycheck, every paycheck, toward your retirement in order to be able to retire with the way that the cost of living is right now. So it obviously depends on your income and your lifestyle and your spending, but that's just a good goal to start with. Again, if you're younger, always start with a Roth IRA. So your taxes are already paid out. That way, then when you go to retire, you don't have to pay the taxes on it. Another thing, try not to ever withdraw from your retirement. I know sometimes people will get into a pinch and so they'll withdraw from their retirement. If you can, try not to do that. And then also, during times like this, a lot of people are asking like, oh, should I sell because the markets went down? No, if anything, the only thing we can expect is the markets will continue to change. So unless you are close to retirement, which if you are, you should be working with a financial advisor. And I should say too, I'm not a financial advisor. Please consult with your financial advisor. This should not be taken as, it's not intended to be, and it shouldn't be perceived as professional financial advice or legal advice. But use an aggressive allocation. So that's going to be stocks. Bonds are considered more conservative and safer, but with more risk, you get more return. So you're going to have a higher return on your stocks than bonds. So choose an aggressive allocation. Don't sell when the market starts to tank because it's going to go back up and you'll probably miss that. So just keep your money in there. And then when you get probably like 5 years from retirement, then you need to start working with a financial advisor to figure out, you want to switch to conservative, to a bond allocation, and then start planning ahead for how you're going to withdraw. Okay, the 4th step is try to have savings. So set up an emergency cash fund. My very first slide said that you should have a target of putting 20% of your money into savings. Now, I know that's difficult for a lot of people. And I will say too, for businesses, I would say even try to have a 10% allocation to savings or to paying yourself. For businesses, reserve 30% for taxes, and then the rest can be allocated towards your operating expenses. So this is where I know it's difficult for a lot of people are just getting by. And so this is why I have this kind of in the 4th step, because I feel like these are the things that you need to do in order. So Start with, try to just at least have $3,000 in savings. Then your next goal should be to have 3 months of your living expenses saved. So again, that's where if you have been tracking your expenses and you can see each month how much you bring in and how much you spend, you want to have 3 months worth of what you spend in a given month. You want to have 3 months of that saved up. Then your last goal can be 6 months. Try to get to the 6-month mark. During times like this, it's my clients and the people I know who have cash saved up, they're the ones who are not freaking out, who are not stressing right now. Again, I know that everybody comes from different backgrounds, and we come from a privileged background, and you know, we have our in-laws are watching our son most of the time, so that's a huge expense that is relieved for us. So I know that this can be difficult, but it's just a goal to work towards. Lastly, you want to have a positive net worth. Your net worth is your assets minus your liabilities. So your assets are going to be your home, your retirement, and cash. Your liabilities is going to be your debt. So your mortgage, your car loans, things like that. Again, coming back to business, people will say you have to spend money to make money. Yes and no. I think that I have the same philosophy with this as I do with like credit cards and other forms of debt. I don't agree with, and I don't encourage my clients to get a loan that they cannot afford the monthly payments for. So I always try to look at worst case scenario. If your business is not bringing in as much revenue, or just for you personally, you can look at this like, if I were to lose my job, what are my operating expenses? What do we have saved up? What could we get by? How long could we get by? And then could we afford our minimum payments? This is where, with the housing crisis, this is where people got in trouble. So I think you cannot have so much debt that you can't afford the monthly payments. And then I also think at a certain point in your life, as you get older, I don't necessarily want to have millions of dollars in debt and leave that with my children, regardless of what my income is. So those are the two things that I think you have to take into consideration when you have that philosophy of, oh, you have to spend money to make money. You just have to be careful about it. So those are my tips. I would say, in addition, just other things that you can do are, I hope you're putting your money to work. So if you do have money in a savings account, like traditional savings account at a bank, there are so many credit unions that offer a much higher interest rate. So the Fed funds rate just got cut. That means that all interest rates will go down. So yes, this is a good time to, if you're considering buying a home or a car, things like that, your interest rate is going to be lower, but then that means that for your savings, your interest rate is going to be lower as well. So make sure, do some shopping, check around with other, traditionally credit unions offer more competitive interest rates than banks. Sorry, but that's just the way it is. So shop around, and if you do have money saved up, try to put that to work. That can make you hundreds of dollars a year by just making sure that you have it in a savings account or a checking account that's earning a decent interest rate. So that's one tip I have. Again, I'll come back to, if you missed the first part, my biggest tip would be, you've already done the hard work of being forced to save your money to cut your spending, and that's the most difficult step to take. So when things return to normal, try to keep these spending habits up, right? Where, okay, you've already proved to yourself that you don't need a coffee every single day. You don't need to go out to eat twice a week. So just keep up with those habits. You've already established them. So why go back to spending? We've cut anywhere from like $200 to $500 a month just with what's going on, and being forced to cut our spending. So that's awesome. Like that's going to add up. So that's another tip I have. So that's all I have for you guys today. If you found this interesting, I will be having, I'm going to do a free webinar probably in June next month about this topic, and we're going to be diving in a little bit more. So if you're interested in that, then go to janiestahl.com and you can sign up where then I'll notify you by email of when that is launching and when it's going out. So yeah, so stay tuned for that. I hope you guys have a great week, and just remember to give yourself grace and stop judging, start helping, and have compassion and empathy for other people and for yourself. And I know that everybody will come out stronger from this. So until next Monday, we'll see you later.